Hey folks, Shawn Plummer over at the Annuity Expert. In today's video, we're going to go over what a non-qualified annuity is, how it works, how the taxes are taken out, liquidity, etc. So non-qualified, when you look at, when you hear the terms qualified and non-qualified, it really refers to the taxation and the IRS labeled account. There's a qualified annuity, which is money that funds an annuity that has been all pre-tax, with the exception of the Roth IRA. And a non-qualified annuity is an annuity funded with after-tax money that the gains have not been taxed yet. They call it tax deferral. Okay, and the idea is with a non-qualified annuity, you are only taxed on the gains that you earn, and there's no contribution limits. There's no RMDs. So in the example, let's just say you have $50,000 in cash. You buy an annuity. That $50,000 annuity grows to $100,000 annuity. The first $50,000 is tax. It can't be taxed because it's already been taxed. And then the other $50,000 is tax deferred interest. So it's taxable income. That 50% that's all gains, once you withdraw it, you have to pay ordinary taxes on, federal, state, just like you're earning a paycheck from work. And the cool thing about the non-qualified annuities is there's no contribution limits, there's no RMDs at age 73, and you can defer the taxes over two spouses' lifetimes. That's also pretty cool. So if you own a non-qualified annuity, you die, your spouse is the primary beneficiary. The spouse doesn't want to pay the taxes at death. She could pick up the contract through spousal continuance and continue to defer the taxes until that spouse has died. And then once both spouses die, then the children will have to pay taxes over a period of time for that. So that's pretty cool. So if you got money that you want to just grow and not worry about the taxes or affecting your retirement, non-qualified annuities are pretty cool in doing that. How non-qualified annuities are taxed. They're taxed two different ways. So if you're annuitizing the contract, which we don't recommend in most scenarios, they're going to have what's called an exclusion ratio on your paycheck. And the exclusion ratio is the ratio of taxable to non-taxable income in your payment. So in the example I used before, you had $50,000 of cash, you bought an annuity, that $50,000 grew to $100,000. It's a 50-50 ratio. 50% of your paycheck will be taxable and the other 50% will not be taxed on that payment. That's the exclusion ratio. If you're taking a withdrawal or you're using a lifetime income rider for lifetime withdrawals, you are being taxed LIFO, last in, first out, which means your interest is going to come out before your after-tax money. And so your paychecks initially, or your withdrawals initially, are going to be fully taxable because this is tax-deferred gains. And then once you eat into all of your gains and you've pocketed that and paid taxes on it, now you're in the after-tax money, and then the remainder is not taxed. So there's a big difference between the two. And the label is annuitization is just distributions, so annuity payments, where a lifetime income rider on a fixed index or variable annuity are considered withdrawals. And they use those two terminologies because it's taxed differently. So yeah, hope you answered your question. If you have any questions, give us a call, 770-755-1565, or visit us at the Annuity Expert. We've got calculators, we've got all the interest rates. You can do it all anonymously. And then leave a comment below. If you got a question or you have a statement, I'll be sure to answer it in the comments over the next couple of days. And then like, subscribe. We'll catch you on the next video. See ya.